As we come to the close of the month of April 2024, I wanted to record this month's video around the basis of financial literacy. You might not be aware, but the month of April is actually known as Financial Literacy Month. So I thought we could take it back to some basics and talk about three important concepts that we use as foundational principles or foundational ideas when we think about investment planning and growing our wealth. So the three concepts I want to go over with you today are, first of all, compound interest. The second thing being the rule of 72, and the third thing being the breakdown of differences between stocks, bonds, and cash. So starting off at the top with compound interest, you've probably heard it said before that compound interest is known as the eighth wonder of the world. That quote specifically goes back with a lot of credit towards Albert Einstein, one of the smartest minds that ever lived. But when we think about compound interest, I think it's important to understand what is actually happening as our money or as our growth is compounding over time. So there's really two different kinds of interest that you've learned about, or you probably might have a recollection of learning about back in middle school or high school math class. Specifically, we have what's called simple interest and then compound interest. Simple interest is the concept where we might have a fixed amount of return based on a specific initial value that's going to keep being the same fixed return off that initial value every single time we get return on our money. Compound interest is different. Compounding is where not just are we getting a return on the initial amount of money we're investing or trying to grow, but we're also getting growth on the growth we receive on a regular basis. So just to break down a very quick example, let's assume we had a $100 investment and we made a 10% rate of return, just to do the math really easily here. If we had simple interest returns, that means for the first year, if we got a 10% return on our money, we would make 10% in earnings on that $100 investment, being a $10 return. The second year, we would get another 10% rate of return or 10% return on our money on that initial investment. So that would be another $10 in return. The third year, the same thing. So after 3 years, we might have started with a $100 investment and it's ended up being $130 in total. Compound interest is different. That's where, again, our money we make is going to make more money for us. So after the first year of that same scenario, $100 initial investment, 10% rate of return, we're going to have a $10 return on that $100 investment. The second year, though, we now have a total of money that's invested of $110, and we're going to make a 10% return on $110 instead of just the initial $100. So 10% of that 110 means we're going to make $11 as our return on that 110. So we're already starting to see a little bit of a difference with compounding versus simple interest. So after year one, we have $110. We make $11 for the second year, and we add that to our 110 starting point. So at the end of year two, we actually have $121 as our total amount of money that we're going to have growing going forward. So we take that same example, go to year three, we get a 10% rate of return on our $121. That's another $12.10. So we keep adding that to our new amount every single period of compounding and get to see the benefit of our growth there. So we can see just from a few quick years, breaking out that example, we start to outpace where after 3 years with that example, we actually end up having about $133.10 instead of just $130 based on our initial investment with simple interest. So this carries over into everything we talk about with relation to investments. So the first rule or the first thing we talked about was compound interest. The second principle we focus on, or second educational item we want to bring up, is the rule of 72. So the rule of 72 is a simple concept based on some math around how money can grow over time. This says if you take the number 72 and divide it by your rate of return. So in this case, let's say divide it by 6. That's an easy number that goes into 72. 72 divided by your rate of return will give you an approximate number of years it would take your money to double in value if you had that consistent return going forward. So let's say it is a 6% rate of return on our money, and we get that 6% every year ongoing. If we take 72 divided by 6, that means every 12 years approximately, our money will double in value without having to add anything to it. We could use that example for a lot of different scenarios. So if you think about your typical savings accounts at a bank, if you're getting a 1% rate of return on your money, that means it's going to take 72 years for that money to double. Whereas if you were getting, say, an average rate of return of the stock market being about 10 to 11%, we'll just say 10 for sake of this, you're looking at growing your money by a factor of 2 every 7 to 7.5 years. So there's a really, really big difference on how our money can grow based on the type of return we get if we get the benefit of compound interest. That carries over to the third principle I want to talk about, which is what we call asset allocation. Asset allocation is just the breakdown of what types of assets we actually have our money invested in to help us grow, preserve, or protect our wealth over time. The three main asset classes we focus on are going to be stocks, bonds, and cash. Stocks are representative of ownership in publicly traded companies primarily. So if you own all the stock of a company, that means you get all the benefit of the growth of that company, but you also do take on all the potential risk of loss if the company's value goes down. If you own bonds, that's a more secure investment than stocks because technically the bond relationship is you are a creditor where you're loaning your money to a government or company organization and they're agreeing to pay you back interest over time. At the end of the term of that bond, you would get your initial investment back, but you've made interest payments over time as long as they haven't defaulted on that bond. So it is more secure than stocks, but you have a much lower rate of return because there's an element of a guarantee associated with that. The third type of asset is going to be cash, or what we call cash equivalents. This is usually really short-term government bonds. It could be commercial paper, it could be money market instruments, CDs, things of that nature. These are going to be the most secure, most guaranteed types of assets we might include in a portfolio. But we have to understand that whenever we give a guarantee or we have a more conservative position, the amount of growth or opportunity to advance our wealth is going to be lower. So all three of these things, principles I'm going over, they relate to each other, right? So compound interest is the foundation of how our money grows for us so we can actually build our wealth instead of just trying to save a bunch of money over time. The rule of 72 helps us understand that if we take certain amounts of risk to try to get a better rate of return over time, we can accelerate the amount of our growth or cut into smaller chunks how long it takes our money to grow for us. And the third thing is by choosing different types of assets, stocks, bonds, or cash, more risk, more reward over here, less risk, less reward over here, that'll give us a varying type of rate of return that we can evaluate how our money could grow over time using the rule of 72. So those are just three basic things I wanted to go back over. I think it's helpful, even if we have a lot of wealth today, just to be reminded of what the foundational principles are, especially as we're looking at volatile markets and we're trying to evaluate what is the right risk-reward ratio we're looking for in our investments. If you have any specific questions based on this about your personal situation, please feel free to reach out to us. We are here to be a resource for you on your financial journey, and we would love to help clarify any questions or concerns you have going forward. Thanks so much for your time, and we'll see you guys next month.